Hi, and welcome back. We're going to talk about picking a market today. Everyone tells you to pick a short-term rental market based on the numbers, occupancy, average daily rate, revenue projections, all of it. And I understand why those things matter, but if you're only using the numbers, you're already behind the eight ball because the best investments, those ones that really outperform, those numbers weren't the only things that I looked at. I tried to look beyond the numbers to what was coming next, something that other people really weren't looking at. I own 4 short-term rental properties across the US, and my overall revenue has grown about 15 to 20% year over year every single year that I've owned it. It's Distilled Destinations. I'm super proud of it. This year, I'm actually currently pacing 50% higher than where I was last year at this time. So here's hoping that trend continues. Things are looking great. That kind of performance doesn't happen just from picking a market straight from the numbers, from the published articles that are out there and the best spreadsheets that are there. It comes really from picking the market right before everyone else sees it. So in this video, I want to walk you through how I actually choose markets and why I think it's a mix of getting those numbers right, sure, but actually something that's a little less obvious and a little maybe harder to see. There's an art to this, and if you can learn to pick up on it and combine it with something that you love, it can give you a real edge. So here's the core idea. The data tells you where a market has been. It does not tell you where a market is going to be. That's the big question. So if you're buying based only on what is already working, you're stepping into a space where everyone has already arrived. That's obviously going to be a problem, right? So if you want average returns, follow that data. But if you want to outperform, you have to start asking, what is about to happen here that the numbers don't fully reflect yet? That's the secret. I have 4 properties. It's not a huge portfolio, it's small. I don't want it to be huge, but they're very intentional and they support both my retirement and the exact life that I want them to support. They support my life the way I want to live. And every one of them, I went about this exact same process. I looked at the numbers, but more than that, I found something special about them. So let's talk about them. My first property was in Steamboat Springs. My family had been going there for decades, so I knew the area already really well, which helped. But what really made me actually move forward there wasn't just the familiarity. At the time, Steamboat had just been acquired by Aspen, and there was a lot of uncertainty around that people just weren't sure what that would mean for the area. But I paid attention. I thought it was going to be great, at least for the numbers in the future. Aspen was planning to really expand the ski area. They were redeveloping the base. They were adding a gondola. They were investing heavily in the resort experience. And then there was something even more important that I thought was happening at the exact same time. There were real constraints on supply. There was limited space to build down at the base. The base wasn't getting any bigger. There was increased licensing restrictions going on for short-term rentals. So I looked at that and thought, this might be exactly the right time. Demand is about to increase. Supply is constrained. That's a really strong position for me to get into. So even though pricing had already gone up post-COVID, all of this was the exact right time to jump in. So over time, it has absolutely showed up in my revenues and in my property values. That's all going exactly the way I want it to go. I got in before those Aspen amenities showed up in Steamboat. Next, I wanted a beach property. I started in Florida, but it didn't fit my budget. So I shifted to Orange Beach, Alabama. And again, the numbers alone weren't what made the decision for me. That wouldn't have made it work there really for me very well at all. It was a combination of things for me in Alabama. Lower insurance costs than Florida was one thing, but also a massive protected state park that was limiting overdevelopment. But here was the big one. The nearby airport was about to go commercial. It was about a year away from that. And that's the kind of thing that really drives demand. Things were shifting there. And I was buying before that fully played out. I was also buying in a new neighborhood that hadn't been built yet. So a little slower burn there, but it's working. My Texas property in Gruene came from just paying attention, really. We would go to concerts at Gruene Hall, and as we were going to those concerts, we found that it was really hard to get transportation afterwards. I remember thinking, why is this so hard? Why is there nowhere to stay around here? Why can't we get an Uber? Then I started digging. There hadn't been any new development on the river close to Gruene Hall in years. So as soon as there was a new development with some new condos right on the river, walking distance with tubing, I jumped on it. So that property's been a steady performer ever since. That's become one of my best. Then there's one more. My most recent purchase is near Asheville. That's an interesting one. It's at a ski resort that wasn't even open yet when I bought it. It had shut down. The resort was being redeveloped, and it's a log cabin. There was a lot of uncertainty around it. I heard about it just from a friend in a Facebook group. A lot of people would have waited, held off on that. The numbers weren't fantastic, but I wasn't buying it for what was happening right then. I was buying it for what would happen 3 to 5 years later, for what it was becoming. It took a little longer. It's just now starting to see its stride. We had a hurricane around Asheville. I'm not sure if you've seen that, but now it's open. It's growing. They're starting to do summer activities. It's gaining traction. They've opened another lift. Here's the broader lesson. When you step back and look at all of these properties that I bought, none of them were just about chasing the numbers. You really have to look at what I was trying to chase was 3 to 5 years down the road. And they're all starting to really see that traction. So where I see everyone else going, oh man, the markets are so hard, I'm seeing 15 to 20% gains in all of my properties year over year. That's more than just the numbers. This could work in other ways too. Think about a company relocating, infrastructure improvements, a university expanding, new demand drivers, anything that shifts demand relative to supply. Think about what that could mean for you. So just to be clear, this doesn't mean ignoring the numbers. You absolutely need the numbers. But if that's all you're using, then you're competing with everyone else that's looking at all of the same data. If you want to get ahead in short-term rentals, you need to find your edge. Start asking better questions. Not, is this a good market today? But will this be a good market in 3 to 5 years? Am I early? That's where the real opportunities are. If you want help learning how to evaluate deals and markets step by step, I've put together some training. I'll link it below, and you can also find it at strjumpstart.com. I'd love to have you follow along with us. Subscribe to our YouTube channel. I'll keep sharing what's been working for me. Thanks. See you soon.